Well, hello everybody, this is Ron Wheeler, and I'll bring you tonight's special presentation from growth to cash flow, shifting your mindset from investing to income trading. And in tonight's presentation, I really just want to focus on how we can break down the differences between what a typical investment is and what we here at VectorVest define as income trading. And I want to cover what I think is the most important mindset shift that's required to make that transition and to introduce you to one of the ways we at VectorVest for the last decade have been teaching our clients, our investors, our students how to create consistent income from trading. So before we even get into that, let's talk about a portfolio allocation. Right now, I am not an investment advisor, never claimed to be. So I went out there and I asked the official investment advisor, ChatGPT, because it's always good to get a uneducated opinion, right? Although I'd say it's educated. How should an investor allocate their portfolio? Now, they kind of answer the way I would answer. There's no single answer to how an investor should allocate their portfolio. It depends on goals, risk, tolerance, time horizon, income needs, market outlook. But here's a general framework. So, conservative, capital preservation, and income. I like that. Capital preservation means you don't lose money, but then also producing income. So I go down there and we'll stick with the conservative investor because I think that's where a lot of us fall and a lot of us should fall. Maybe a small portion of our portfolio towards some more aggressive strategies, but conservative is where I like to consider myself too. So we go on to step two, sample asset allocation models. Conservative. 60 to 70% bonds. I think that's probably a little heavy. 20 to 30% stocks, blue chip, dividend paying. 5 to 10% cash. So this part right here, blue chip, dividend paying, they're saying that's kind of a combination, it looks like, between your typical stock, but then it also produces income. Now, that's not bad, right? It's not a bad starting point. However, in a lot of trading and a lot of investing, we can kind of do a little bit of both, and that's the power of VectorVest, right? We can do a stock-based portfolio based on capital appreciation with good dividend-based stocks. That's what I do in my investments. I'm not much of a stock trader. I don't like to go out there and have 30, 40 stocks that I own. I have a couple of stocks that I own that all pay good dividends. That's part of my income production. So I kind of blend the capital appreciation with some of my income. Now, where I take it a step beyond is I take a portion of my portfolio dedicated specifically to income production without the use of stocks. And I'm going to talk about that a little bit tonight as we differentiate the differences in investing and income. So ultimately, all investors should target a portion of their portfolio to some sort of income production, whether it's like we talked about, dividends, whether we do anything, there should be some sort of income production. Now, when we talk about income, let's make a base description of this thing. I don't like to assume prior knowledge, and I also like to start from a base where we're all on the same page. So income, money received, especially on a regular basis for work or through investments. Paycheck is income. If I get dividends 4 times a year or 1 time a year from a stock, that's income. I get it on a regular basis. If I do, maybe I have rental properties and I get rental income, it's income, right? It's something that you should be getting hopefully on a monthly basis. Now, one of the biggest shifts that you have to make in your mindset is the shift to understanding how we can put probability into our trades, into our investments. And this is kind of a age-old comparison. It's kind of a, one that's very popular in the industry. But we say you have to kind of think like a casino, right? Let's talk about the casinos. Casinos. There's a really easy way to beat every casino game out there. There really, really is. It's called a progression betting system, right? You bet $1. If you lose, you bet 2. If you lose on the 2, you double your bet to 4. You lose 4, you double your bet to 8, right? There is no chance that you will ever lose using a progression system as long as you have an unlimited bankroll. However, the casinos know this. So what do? They impose a table limit. The table limit prohibits you from doing the progression system because eventually the progression system will go to a point where you're going to max out the table limit. That's one of the basic ways that they do that to prohibit you and put the odds of probability back in their favor. It's kind of like a roulette wheel, right? You look at a roulette wheel and you assume, oh, there's all the red numbers and black numbers. Yeah, there's only one or two greens, but it's essentially a 50-50 shot. Essentially, right? That whole desert was built on, a couple of percentage points of probability, right? They know that. Another thing about roulette, and a lot of people don't know this, is they start, this has been a long time now, but they have those number boards, right? It's a concept of fooled by randomness, right? You walk past the number board and there's like 9 red numbers in a row. So you're like, oh, black is due. Black is not due. It's the same statistical chance you have every single turn of the wheel. But they know this, and that's another way that they fool you into thinking there might be patterns, right? That's how a casino operates. Well, what we need to do as an investor is get into that shift. We want to start thinking like the casino and not like the gambler. So let's talk about how to make the shift here. So what you're looking at here is a profit graph on Apple. So let's say you go out there, you buy 100 shares of Apple. Might not be the best day to buy Apple based on how the current color guard is. It's August 1st, but let's just for the heck of it say we go out there and buy Apple. This is what I mean by you don't make money unless the asset goes in your direction, unless it increases in price. So this risk or this profit graph has two axes, however you say that, right? Over on the right, the vertical axis, okay, axis. I know, I'm going to keep saying that now. It's getting to be funny for me. Anyway, over on the right one, the vertical plane. This is your profit or this is your loss. Now that is based on this down here, the horizontal axis. So down here, this is the stock price. So what we do is just like a regular graph. If the stock were to go to 206, we just line that guy up with the vertical side, and we would see we'd make $256 on this 100 shares of Apple. If the stock were to decline to $200 down here, you would see that you would be down on the trade about $338. So all this is telling you is what the profit or the loss of your asset is based on the price of it increasing or decreasing. Now, you can kind of see where I drew that blue arrow. It's kind of moving back and forth. When the market's open, it's real time. Now, when you buy a stock, right, a stock essentially, and I understand it's not perfect math, but it's like a zero-sum game. You only make money if the stock were to increase in price. If it decreases in price, you will lose, right? That's the basis of a stock purchase. Now, if it pays dividends, the dividends will hopefully offset any loss on the capital side, and they will boost profits if it goes up. That's great. But what I want to do is I want to set up a trade where I can profit on this position even if the stock doesn't go up or even if it comes down a little bit. Now, how do we do it? And we talked earlier about the mindset shift, right, to being the casino, right? Well, if you think about it, what we are going to do is we are going to become the casino. We are going to essentially, and this is not a perfect description, so you'll have to kind of work with my analogy here. We are going to become the casino and essentially take bets on the stock. So the first way we do it is when you have an option, people that buy a call generally, okay, so again, just work with the analogy here. When you buy a call on a stock, you generally think the stock will go up, right? Because if I go out to, and I'll open up another profit graph here, and on Apple, if I were to go out there and buy an August $202 call, again, look at the profit graph here, right? If the stock were to go up, I profit. If the stock were to go down, I fail. So when you buy a call, essentially it is a prediction that you think the stock will go up. So what we're going to do is we're going to take some action on Apple, right? There's buyers out there of options all over the place. There's somebody out there that I bet over the next 2 months thinks that Apple is going to go to $208 a share. Right there. I can put the arrow up this way. So what I'm going to go out there and do is I'll take their bet. I'm going to sell them 1, and we'll go to September. And okay, that's fine. There's no 208. Let's just do a 210. That's close enough. Let's sell them that 210 call. Now, when we sell them that call, we're essentially taking the bet that Apple may not go to 210. They're thinking it will. You're taking the other side of that bet. So when I do that, watch what happens. I'm going to sell that option against my 100 shares. Now, I want you to watch the profit graph when I do that. This is what that profit graph has now done. I own the stock. Take a look. Right here is where the purchase price is. If the asset Apple goes up in value, I make money. If Apple goes absolutely nowhere, I will still make money. That's the importance of this green section right here. As long as by expiration, Apple is now above $100 and essentially $98 a share, I will make money. What you've created is you've created a scenario where even if the stock goes against you, you can still make money. Now, this is a covered call. It's the most basic form of income trading you could do. And it's something, again, I think everybody should do. Now, there's downsides of the covered call. The downside of the covered call is you have to own the stock. And that could be expensive, right? Stocks can gap. They can have big changes. You know, they have earnings events, all kinds of things. A covered call is a great trade. And again, by selling an option against your position, you create where you can have a trade that doesn't even go in your favor and still makes money. Now, the worst thing that can happen to you is the best thing that can happen to you if it goes up. If it goes up, worst case scenario, you might have to go out there and get rid of your stock at $210 a share. That's okay, though. You bought the stock for like 203. Now you got to sell it to somebody for 210. That's fine. That's a covered call. But the key principle here is this. You've created a scenario where if the stock goes sideways, you are profitable. Even if it goes down, you are profitable. Okay? That's the idea that we want from this. Now, in this scenario, I also want to introduce you to one more thing. It's called probability. What is the statistical probability that Apple will be at or above $210 by September 19th? Well, that's the beauty. Options have probabilities built into them, and that probability is based on the historical movement of the stock. So if I take a look right here, 26%, there is a 26% that the stock will be at or above 210 in September. Okay, 26%. That flips the odds to your side. There's a 26% chance that it will be, but now there's basically a 74% chance of it not being. You're putting the odds of success in your favor. And ultimately, it really doesn't matter if it goes in the money or not. You're still in a position where it can go up as far as you want it to, and you're still going to make money. And again, you're still in that position where it can come down and you can make money. That's the beauty of this. Now, let's transition to a cheaper way to do this. A way that I don't have to buy 100 shares of stock. All I'm going to do is use the probability of options to set myself up a low risk, high probability scenario on something like Apple. And again, I'm just using Apple as an example here. I'm not giving this as a trade idea or a trade concept. I'm just using this as an example here. So what I like to do in the options world is this. When I think a stock will go up, I don't buy a call. I sell a put. Now, why do I sell a put if I think a stock is going to go up? I sell a put because as the stock goes up in value, the put is going to decline in value. So here's what I mean by this. If I went out here on Apple, and let's remove the stock purchase, I'm just going to sell a $195 put on Apple. All right, so there's my put on Apple. Now, I'm going to do something here just so I don't have any confusion. This is by selling a $195 put. What I want to see happen is I want to see, and again, because I'm bullish, I want to make sure that if the stock goes up in value, I make money. So you can see as far as I stretch this risk graph and go back and farther up, Apple gets to $700 a share. I'm getting ridiculous here. It doesn't matter. I still am making money. It doesn't matter how far Apple goes up, this position would be profitable. Now, what are the nuts and bolts behind how this position makes money? Well, as I said, when you sell an option, you're getting paid. So if I go out to my broker right now and I sell a 195 put, I would get paid $4.55. Now, when you sell an option or buy an option, regardless, it doesn't matter. When you take an option transaction, that's based on 100 shares. So I'm going to get paid $4 in this case, like 55 cents times 100. I would get paid $455. Now, I can make the entire $455 in 49 days if Apple stays above 195. Now, what are the odds that Apple is going to stay above 195 by September 19th? If I go look at my probability, it's 27% that this option will be in the money. Now, what that means is simply this. Apple would have to fall below 195 to be quote unquote in the money. So this position has a 27% chance of going in the money. That's essentially meaning you're going to lose. Then it has a 73% chance of winning. Again, you're taking the other side of the bet here. You're not betting that Apple's going to go down. You're betting that Apple's going to go up. Now, if somebody goes out there and buys that put, they're projecting or they're betting that Apple might go down. You're taking essentially the other side of the position. You're taking their bets. You're becoming the casino. All that we've got to do now is stay above 195. Now, if you look over to the right, this is where this starts to get a little bit scary. You have the chance to make $495 or $455 on this trade, but you have the risk of $19,000. Let's also talk some other risks here, because when you sell an option, like I showed you in the covered call, when you sell an option, it's not like you're out there selling a car, right? You sign the title over, you walk away, you're done. When you sell a put has an obligation to it if and only if you let the option expire in the money, or you let your option buyer or unoptioned buyer assign the option. So when I sell a put, my obligation is that I may be called upon to buy the stock from somebody. So if the stock goes down too far, I may have to buy Apple for $195. I would still make my $455. That premium would go to me, but I may now have to buy the stock for $195. I don't ever want that to happen. I've been trading these types of options and doing this for 15 years now. I've never in one of these types of transactions have ever been assigned an option to this. And the reason why, it's because I would never hold the trade that long or put the trade into a situation where you would be under pressure or under risk of that option being assigned to you. So keep in mind, when we do this position, there's no stock involved ever. Now, we're not going to sell that put by itself. We're going to use some protection here to limit our risk, okay? And I'll explain how that works here in just a second. So what we're going to do is, first off, I want you to understand the layout here. I'm going to add a line to my profit graph. Now, this is the line of what would happen today. So if Apple were to rise in price, and again, down here, this is the price of the stock. Over on the right, this is the price and profit you would have. So if the stock goes up to $215, you would be up on your position about $249. How would you be up that way? Because when you sell a put and the stock goes up, you will profit, right? Because the option is losing value. Think about this. If you've ever traded an option before, if you bought a put and the stock goes up, you know that your put is in danger of expiring worthless and losing money. Well, now you're the other side. You're the other side of the trade. So when you sell a put and the stock goes up, it's going to decrease in value. Now, the cool thing is with these options, you can exit these anytime you want. I can buy an option on August 1st and I can sell an option on August 5th. I can sell an option on August 1st and then I can exit the position anytime after that at the current market price. Now, what the real risk is here in this, and this is the way that we teach our income producing option spreads. We are going to keep the trade until we reach half of our projected profit. So somewhere up and around the $217 range, we would exit the position. Why? Because keeping it for any longer, it's going to require the stock to go up a lot more. Or you're going to be sitting in a position for 3-4 weeks where all you're getting is seeing that option bleed in time. It's not really worth it. So take your 50%, exit the trade, and then you can reallocate your income to something else. And if Apple is continuing to go up, you might find that doing another Apple trade makes more sense, right? However, what if Apple goes down? So if Apple goes down, I'm going to use the price of my strike, the 195, as my stop. So if Apple were to drop below 195, I would take a $323 loss on this trade. I can make about 220. I would lose about 323. Now, does that risk sound appropriate here? Well, let's do some math. Let's talk statistics. This trade, and I'm just going to round. Let's say it's got a 75% chance of success. It's pretty close at 26, right? So if I take the trade 10 times, when I take the trade 10 times, if I win 7.5 times, I know you can't win 0.5, but we're talking about real numbers here. 7.5, if I were to make $220, 7.5 times, I'm going to profit by $1,650. Now, if I lose 2.5 times, at 330, I'm going to lose 825. So as long as the statistical accuracy of the trade works, I'm going to walk away from this making money. And the way that you do it is you have to make sure you're using stops no different than you would do with any other trade. Whether you're doing a dividend trade, whether you're doing a covered call, you're always going to choose a point to exit that position. Now, the real risk of this spread comes in if the stock makes a massive move. What happens if all of a sudden something crazy happens with Apple, Tim Cook resigns, or he's accused of fraud or something crazy like that? And what happens if Apple opens up the next day at $180 a share? Well, now what's happened is you're in a position where you thought you were going to lose 300, but now you're losing 1289. This is the kind of thing that can happen if you are selling an option, what we call naked. Well, we're not going to do that. We're going to sell an option and we're going to protect this position. And here's how we do it. We're going to go under that 195 a little bit in price. And we're going to buy a put. So let's say we buy a 190 put. Now, I don't want to just say we're going to buy a 190 put. There's a reason we do this, and the reason that 190 is probably appropriate. It all comes back into the risk reward of the trade. You kind of saw a glimpse of that when I said, okay, 7.5 times you make 220, 2.5 times you lose 330. You see the numbers, how they play out. You're going to pick the prices that give you the most probability. Typically, I want 60% or better that I'm going to win, and then the insurance that gives me the proper layout of risk reward. Now, what this has done to you in this trade is it's kind of limited your risk here. Now, let me talk about the absolute worst thing that could happen to you in this trade. The worst thing that could happen is if the stock had a big sell-off at 180, okay, you might be put to having to buy Apple at 195. That's your obligation as an option seller. Remember, you might have to buy the stock. However, when you buy a put, you now have the right to sell the stock to somebody else. So if I had to buy it for 195, I can turn around and sell it to somebody else for 190. Now, let me tell you, in 15 years of doing these spreads the way that I do them, that's never happened to me. Okay, so it's something you're not going to have to worry about. Realistically, what would happen if the stock suddenly dropped down to 180? You're going to take a loss for about $272. It's going to be a bigger loss than you expected, but it's not going to be a catastrophic loss. And that would require like a black swan event, something that doesn't happen very often. I've only had something like this happen to me one time in a trade in 15 years. And it was a bigger loss than I expected, but it wasn't catastrophic. Now, what this insurance has done for you, okay? Number one, it's capped the risk. You have a $380 maximum risk on the trade. It's also reduced your profits. You can make about $60 on the trade, and if the trade moves against you now, you only lose about 96 bucks. So you have a $60 potential gain, a $96 potential loss, okay? And a 75% chance of making money. So again, let's do the math. 7.5 times, let's say, $60. You have a 2.5 time or 2.5 of losing 90. I think it was 96. You're coming out ahead. You're going to make money with this trade, provided you do the right risk. Now, here's the beauty of this trade. If you have a $5,000 account that you want to play around with and to start doing some income trades, the only thing that the broker is going to require you to put up in this trade is as much as $500. That's it. This trade requires $500 in maximum margin. That's all you'd have to put up there. But Ron, I'm trading $100,000 in capital for my income. What do I do next? Well, in that case, you would increase the number of contracts. What if I traded 18 contracts of this? Well, now your credit's $2,000. We can make $1,000, and the risk is still going to be proportional, right? The risk doesn't go up in proportion. It's still the same level of risk, all right? But you can increase the contract size to get it to a more appropriate level. And trading 18 contracts on this is not a big deal. We've already had 4,000 contracts of that 195 sold today, or traded today. We already had 1,000, and we have over 20,000 open interest on the one leg and 18,000 on the next. This trade right here would essentially require you, in most brokers, to put up the max risk, which is $6,800. Think about this, right? When you trade 18 contracts, that's the equivalent, okay, of trading 1,800 shares of Apple at $204 a share. That's a lot of money that you'd have to put up, okay? That's a lot of money. The beauty of doing these spreads is I call it another version of a poor man's covered call. You manage it just like you would a stock trade, like a covered call. You give it a stop. In this case, the stop is built in. If I think the stock's going to stay above 195, that's where I sell. I sell the 195. And as long as that risk management scenario works out, then guess what? You've now put together a trade that statistically should work 75% of the time. And even when you're wrong, you're not going to lose money. That is the beauty of this. That's the beauty of what we do. That is the beauty of cheap income investing. Okay? And again, control the risk rate, control your profits. You can make money doing this. This is the hallmark of what we've done for the last 10 years in the Options Paycheck experience. And this is the concept of what I do year in and year out in the Ultimate Retirement Solution coaching plan. Now, I mentioned the coaching program for one thing. I do these trades live, the same ideas with my clients every Monday, sometimes Wednesdays too. That's why on that date, and I keep a spreadsheet of all my trades. So Monday, you see a couple on Thursday and Wednesday, but for the most part, if I go through all my trades, most of them are done on Monday. And you see I've done all directions this year. I've done down trades for bearish trades, up trades for bullish. But what I want to show you guys over here is kind of like the big numbers. So far this year, we've done 76 trades, 60% winning rate. My average gain is 742. My average loss is 730. The average days in trade is about 9.6 days. And I've got about a 12% return this year. $100,000 in capital, 12% return. Now, I also do this on the SPX. So you can see I place a lot less SPX trades, typically one a week, mostly on Mondays, but some I've placed on Wednesday and Thursday, and then occasionally a Tuesday if there's a holiday. But over here, we're sitting at 18 wins, 14 losses, with a total profit of about $9,300. Again, if you're doing $100,000 in capital, that's about 9% return. So about 20% return overall from using this approach on both the stocks and the SPX. That's real results that we see using this type of approach. So this is something really, again, that I talk about that really every investor should know and should use and should employ. So if it's something that you're interested in, let me give you some details about how you can get started on this if you're interested. A few times a year, we launch the Options Paycheck experience, and this is your way of learning exactly how we do these spreads, how we manage them, how we find them, basically everything that you need to know. It's an 8-module course, and all along the way we teach you everything that you know to put that strategic mindset shift in work, how you can essentially become the casino. We start off, if you have a very limited amount of options knowledge, we start off in our first 2 modules by teaching you the basics of options. You'll know what a spread is, you'll understand what a call and a put is, some of the terms that you need to know. Then after that, we're going to start putting this in order for you. Module 3 about when you should trade bullish or bearish. You saw in my trade spreadsheet that I switch back and forth. As you know, we've been in a pretty good bullish trend lately. Might be topping right now. It's hard to say. You know, today is the market's down. I don't know what it was, now like 100 points last time I looked. But you know, tariff stuff and up it's 83 points. We're getting a nice rally. But I'm joking there. But we need to know what to do, whether it's bullish or bearish. We're going to show you in Module 4 how to find the stocks, how to select the right options in Module 5. That way, you know, you're not taking my word for it. Oh, the 195, how did Ron know that? I'm going to show you exactly how I selected that, exactly why I selected it. Module 6, understanding probability a little bit more, making sure your insurance leg is correct, where I bought that 190. Module 7, all that you need to know about risk and reward. Okay, this is what's going to help you put together the perfect trade. And then in Module 8, we talk about the execution of the trade. So that's the broker part, where how to put your orders on, things that you can look at in your broker and see exactly what we do. We also include a mastery package. This course is taught live in August and September, 2 modules a week, but we also give you a mastery package. That way you can meet with us live 3 times a week. You're going to get a private dedicated email. If you've never had Options Pro before, we give you a trial subscription to that for August and September. That way you can try out Options Pro like I was using. You don't need to use it, but it's all nice if we can learn from the same platform and have some basic and common knowledge. But you can use your broker software for this as well, so keep that in mind. We also have in September, the implementation month, those trades that I showed you that I placed live with my clients. You're going to be invited to that in the month of September. That way you can learn from me. You can see how I do the trades. For better or worse, if I make money, if I have a bad trade, you're going to see how I react to it, how I stop out of the trade. The SPX has been a pivotal part of my trading portfolio for 20 years. In fact, I started trading the S&P futures back in 97, so I've always traded some variation of the SPX. This is where we take the entire system and kind of boil it down into one trade. Okay, this is something that anybody can do. All you need is about 15 minutes a week and a piece of broker software that can do the trade. It's a very, very simple way to start yourself with creating an income producing account. So nice little package that you get there with the Options Paycheck. We teach the class again live in August and September. And then, you know, you'll get access to the recorded materials for a year. You'll get access to that private email. And we do have a great early bird special. If you order before 6 p.m. Monday, that would be, I have to look at my calendar, Monday, August 4th, then you can get the early bird price of $9.95. So it's definitely worth checking out if you've never done this before. You know, don't let the fear of options, don't let the fear of this kind of hold you back. It's something that every investor should know. And, you know, I also say that we offer a 100% money back guarantee with the course. If you find that, you know, after you go through the course that you don't think it's true, just let us know. We can certainly issue you a refund. All you got to do within a week of ending the course, just let us know that it didn't work out for you, and we will be happy to do that.